Welcome investors to a new video. Today we will think about India's energy transition theme. So what do we usually see?
Solar parks stretch across deserts, wind turbines spinning at coastlines, but it often goes unnoticed that generating electricity is only the first step in the journey. And this creates a fascinating reality. Every time India adds a new solar park, a new industrial corridor, a new manufacturing cluster, or even a new data center, a new layer of infrastructure needs to be built in the background, as the transmission lines need to be built with substations, distribution networks, transformers, before a single unit of electricity can actually reach the end consumer. And while the companies responsible for building this infrastructure rarely become part of the conversation. Over the next several years, India is undertaking its largest transmission and distribution expansion programs of 9.2 lakh crores till FY32, along with state utilities continuing spending on grid expansion and network modernization. This brings us to the company we are discussing today. While it participates in building the infrastructure to move electricity from the point of generation to the point of consumption. Through transmission lines, substations, distribution networks, transformer manufacturing, and now battery energy storage systems, management is attempting to build a broader power infrastructure platform until recently was primarily an EPC contractor. The real question is whether the company can use this infrastructure cycle to evolve from a regional EPC player into a much larger participant in India's growing power ecosystem. Why is India's grid becoming the next big infrastructure opportunity? India's power demand continues to rise as urbanization accelerates, with manufacturing activities and electricity consumption across industries. At the same time, entirely new sources of demand are emerging. Data centers, electric vehicle charging infrastructure, industrial corridors are becoming more electricity intensive, and renewable energy capacity additions continue to grow each year. Where does the company fit in the power ecosystem? To answer that, let us briefly understand how electricity reaches us after it is generated. The journey begins at a power plant, whether it is a solar park, wind farm, thermal station, or hydro project. From there, electricity enters the transmission network, where high voltage transmission lines carry power across long distances to major substations, and then the voltage is brought to suitable levels before electricity moves into the distribution network, which finally delivers power to end users. What makes this entire process interesting is that every stage requires specialized infrastructure. Transmission lines need to be built with substations, underground cabling, and distribution networks for modernization, while transformers ensure that electricity can safely move across different voltage levels before reaching the end user. This is precisely where today's company arrives, Viviana Power. The primary business involves building transmission and distribution network lines, EHV substations, underground cabling, grid modernization services. In FY26, the company has started expanding beyond EPC execution into transformer manufacturing and battery energy storage systems, increasing its presence across the power infrastructure value chain. In simple terms, every time a government utility or private developer decides to strengthen the electricity network, whether by building a new transmission line, upgrading an existing substation, expanding a distribution network, Viviana positions itself as capable to execute, connecting future growth power infrastructure themes. How does Viviana actually build its business? Because unlike a manufacturer that sells products through distributors or a utility that earns regulated returns by owning transmission assets, Viviana operates as an engineering, procurement and construction or EPC contractor. In simple terms, whenever government utilities, renewable energy developers or industrial customers plan to build transmission lines, substations or strengthen distribution infrastructure, they first release project tenders. This is where EPC companies participate through competitive bids, and successful bidder takes responsibility for designing, procuring materials, constructing the project, testing the system, finally commissioning for the customer. This makes execution the most important capability, while winning an order is only the beginning, because the company must complete projects within timelines, manage procurement, coordinate with multiple stakeholders, and maintain quality standards, while working across different locations. As execution improves, it strengthens the company's reputation with utilities and increases the probability of qualifying for larger and more complex projects in the future. Today, the EPC business forms the backbone of Viviana Power, accounting for 94% in FY26 revenues. However, what makes the management strategy particularly interesting is that it is no longer looking at EPC execution as a standalone business. Instead, it is gradually building additional businesses around this core platform, creating multiple growth engines that can support each other over the long term. Alongside EPC execution, the company has entered transformer manufacturing through its acquisition of Arch Transformers, along with their building capabilities in battery energy storage systems, and continues to develop commercial real estate assets that can support working capital requirements for future expansion. Rather than operating as four unrelated businesses, management intends to create an integrated platform where each segment strengthens the others, making the overall business more scalable as India's power infrastructure cycle continues to expand. And to understand whether this strategy can actually create long-term value, we first need to look at each of these businesses individually, starting with the segment which contributes majority of the revenue, its power transmission and distribution EPC business. In FY26, 94% of Viviana Power's revenue came from the power transmission and distribution EPC segment, making it the foundation upon which management is trying to build its future growth initiative. But saying the company is an EPC contractor still doesn't explain what it actually does on the ground. Imagine a state utility wants to strengthen the electricity network, renewable energy capacity to be added, or an existing transmission corridor has reached its limits. Before electricity can flow through that network, someone has to construct the transmission lines, build substations, install underground cables wherever required, integrate the electrical systems, test the complete infrastructure, and finally commission the project for commercial use. And this entire responsibility is where Viviana Power takes the control. Over the years, the company has built capabilities across transmission lines, extra high voltage substations, distribution network development, underground cable laying, grid modernization projects, and testing and commissioning services. It has execution experience across substations up to 400 kV, transmission line projects up to 765 kV, while also participating in renewable energy evacuation infrastructure and grid connectivity projects. Another important aspect of this business is the customer profile. Viviana works with government utilities, GETCO, and the state discoms, and in private sector, Adani, Reliance Industries, BHEL, L&T, Suzlon, Renew, and Vari. And perhaps the biggest advantage of an execution-led business is that every successfully completed project strengthens future eligibility, as utilities prefer contractors with an established execution track record to expand their footprint in the upcoming TBCB and HVDC projects. The next question naturally becomes, if execution is Viviana's biggest strength, where will the future projects actually come from? Gujarat's power sector is experiencing an infrastructure boom, high voltage renewable energy evacuation, and increased budget for GATECO and state discoms. Growth is accelerated by strategic RDSS projects, TBCB order pipelines, and rapid reconductoring to overcome right-of-way issues. An even bigger advantage is their Gujarat presence, fastest growing markets in the country. GATECO has planned capex worth 96,000 crore Indian rupees by FY32, annually 10,000 crore Indian rupees. In Gujarat alone, there was an addressable market worth 4,500 crore Indian rupees in fiscal year 26. While EPC growth depends on utility tenders, investors shouldn't just track revenue. We need to watch government spending, tender pipelines, and utility budgets as these drive future orders and earnings. Tracking all this isn't easy. That's why we've built a dedicated research desk to do it for you.
And investors, we also find these small cap, micro cap, and SME opportunities at an early stage through our research services, Emerging Titans and Tiny Titans. Emerging Titans is mainly built for mainboard small and mid cap companies, while Tiny Titans focuses purely on SME listed stocks. Across both services, you receive detailed research reports, entry and exit strategy, allocation guidance, and regular updates. So if you want to be part of our research community, you can visit valueeducator.com or check the link in the description. We follow our sprint strategy framework to discover such niche stocks with strong potential.
Let's get back to our discussion. So when we look at the order book, 1,000 crore rupees provides visibility for fiscal year 27. And with this has started to move up the value chain through the transformer business. If the EPC business itself is growing, the obvious question becomes, why did the management decide to enter transformer manufacturing? Equipment used in EPC business is supplied by manufacturers, and by entering the transformer manufacturing, Viviana is vertically integrated in the power equipment market with the acquiring 75% stake in Arch Transformers, providing the manufacturing and product design expertise, building network in supply chain, and a direct participation ticket for transformer tenders floated by utilities. By fiscal year 27, the manufacturing capacity for power and distribution transformers will reach 2000 megavolt amperes, and by FY28, this capacity will go up to 5000 megavolt amperes. The roadmap includes expanding manufacturing capabilities from conventional distribution transformers towards utility-scale power transformers, initially targeting the 220 kV segment before scaling the rating capacity up to 400 kV along with other products, shunt reactors, converter duty transformers for renewable energy, data centers, and transmission infrastructure. To support this transition, 100 crore Indian rupees greenfield expansion for transformer manufacturing facility across 14 acres in Vadodara, Gujarat. They have planned an in-house high-voltage testing laboratory, improving certification timelines and strengthening quality control. Although the transformer business stands at 9 crore Indian rupees in fiscal year 26, management targets for 30 to 40 crore Indian rupees revenue by fiscal year 28, improving integration to build their competitive position. Now, at first glance, BESS may appear as an add-on business, but the company is trying to achieve something much bigger than simply generating revenue from battery storage. To understand this, we first need to understand why battery storage has suddenly become such an important part of India's power sector. As renewable energy is growing rapidly, unlike conventional thermal power plants, solar and wind power cannot generate electricity consistently throughout the day, as solar power disappears after sunset and wind generation depends entirely on weather conditions. This creates fluctuations in electricity supply, making grid stability one of the biggest challenges for utilities. This is precisely where battery energy storage systems become important. Large battery systems store surplus electricity whenever generation exceeds demand and then discharge that electricity back into the grid whenever demand rises or renewable generation falls. Instead of allowing renewable energy to go unused, BESS helps balance the grid while improving reliability and ensuring uninterrupted power supply. Recognizing this opportunity, the Government of India supports through the 4,000 MWh Viability Gap Funding Scheme, approving 30 GWh National Energy Storage Program with ISTS charge waivers. As renewable energy penetration continues to increase, BESS is becoming an integral part of the power infrastructure. This is where Viviana has secured 165 megawatts and 330 megawatt-hours BESS capacity through projects in Rajasthan and Gujarat worth 500 crore rupees. Generating 40 crore rupees recurring revenues over 12 years and then a 25% salvage value, these are the technical credentials that become increasingly important as companies move towards TBCB and HVDC infrastructure projects, and to bid for these projects, Viviana is building its net worth and credibility. As of today, the company's highest single bid order size stands at 100 crore Indian rupees, and the company plans to enter 250 to 300 crore Indian rupees of single bid order size, while it strengthens qualification profile for much larger opportunities under the Ministry of Power, including tariff-based competitive bidding (TBCB) projects, and over the longer term participation in the HVDC ecosystem, where single bid order size ranges from 1,000 to 5,000 crore rupees. So rather than looking at BESS purely as another revenue segment, it may be more appropriate to view it as an investment for the company's future business growth. The recurring income from these projects is certainly valuable, but the larger objective appears to be creating the technical track record for the high-value transmission infrastructure projects. By now, the broader strategy starts becoming clear as a company is strengthening the EPC business, expanding into transformer manufacturing, and building technical credentials through battery energy storage systems. However, one important question still remains. If the opportunity is this large, who else is competing for it, and where exactly does Viviana Power stand among its peers? When we look at the EPC industry, Rajesh Power, KEC International, Kalpataru Projects, and Larsen & Toubro already operate at a much larger scale, handling projects across transmission lines, substations, and utility infrastructure. Their order books run into several thousand crores, they possess decades of execution experience, and regularly participate in some of India's largest transmission projects. At first glance, comparing Viviana with these companies may appear unfair because the scale difference is significant. However, the comparison becomes much more meaningful when we look at the minimum project size each company typically executes rather than simply comparing total revenues or order books. Today, Viviana participates in projects with ticket size of 100 crore Indian rupees. When compared to Rajesh Power, they have moved to single order size of projects worth 300 crore rupees and future targets for projects worth 500 crore rupees. This progression is important because in EPC business, ability to bid for larger projects is not determined by ambition alone. You need credibility and net worth. Rajesh Power has built niche in underground cabling, with 75% orders coming for underground cabling. This specialization has allowed them towards underground transmission infrastructure projects in smart cities. Rajesh Power has also secured a 65 megawatt and 130 megawatt hours BESS project in Gujarat. However, unlike Viviana, the company is currently focusing on the EPC model rather than the BESS model. This distinction is under the EPC model. The contractor is responsible for designing, supplying, constructing and commissioning the project, after which ownership is transferred to the customer. The company earns its revenue once the project is executed, resulting in lower capital requirements, faster cash conversion and reduced operational risks. On the other hand, the BOO model requires the company to build, own and operate the battery storage asset for several years. Although this approach demands higher upfront capital and increases leverage, it also creates a recurring annuity-like revenue stream over the life of the project. Viviana has chosen this route because management believes that operating utility-scale BESS assets will not only generate long-term cash flows, but also build technical expertise and credibility, strengthening its qualification for larger opportunities such as TBCB and eventually HVDC projects. Rajesh Power, in contrast, appears to be prioritizing an asset-light, execution-driven strategy with lower financial risk and quicker capital rotation. In Gujarat alone, the addressable EPC market stood at 4,500 crore rupees in FY26, with several established players competing for projects. Despite this competitive environment, Rajesh Power has built an order book of 3,326 crore Indian rupees and has set a target of 5,000 crore Indian rupees worth order book. This demonstrates two important points. First, the opportunity in Gujarat is large enough for multiple companies to grow. Second, contractors with strong execution capabilities and established utility relationships can continue gaining market share despite intense competition. Moving further up the ladder, companies like KEC International and Kalpataru Projects bid for projects worth 500 crore rupees, while Larsen & Toubro compete for 1,000 crore rupees, a shift that changes business scale. KEC International's average order size has increased to 500 crore rupees, achieving an annual order intake of 25,280 crore with total order book at 36,000 crore, backed by a tender pipeline of 1.8 lakh crore. It has also secured multiple HVDC projects showcasing their capabilities. This reflects the typical EPC progression. Companies move from 100 crore rupees projects to 300 crore rupees, then 500 crore rupees before entering large-scale national transmission projects. Viviana appears to be following a similar path, focusing on EPC execution, transformer manufacturing and BESS to gradually qualify for larger projects and potentially move into TBCB and HVDC opportunities over time. Talking about profitability metrics, Viviana's EBITDA operated with superior margins at 14 to 15%. While these numbers are higher when compared to other players and cannot be directly compared due to differences in project mix and scale. Let's now come to the transformer segment. Following a similar journey of gradual scaling when compared to its peers, Transformers and Rectifiers India Limited, Viviana is at an early stage. However, comparing the two companies helps us understand the direction in which Viviana is trying to build its manufacturing business rather than comparing to their current scale. Taril operates with EBITDA margins in the range of 14 to 16% and has been expanding its manufacturing capacity to meet rising demand from utilities and private developers. The company is doing capex at Changodar and Moraiya plants of 15,000 and 22,000 megavolt amperes. Such large-scale capacity additions indicate that transformer demand is no longer limited to replacement orders and is increasingly driven by transmission expansion, renewable energy integration, and grid modernization. This industry-wide capacity expansion provides an important insight for Viviana's strategy. While they currently manufacture distribution and power transformers, they have announced plans to move towards higher capacity transformers. If transformer demand continues to grow, Viviana will benefit at a time when the overall industry is expanding. Coming to constraints, even established players faced execution challenges as Taril had guided for an order book of 8,000 crore but has 5,000 crore order book as the business depends heavily on execution, order inflows and market conditions. Looking at the overall picture, Viviana is building technical capabilities, improving qualification and increasing the value of the bid order size of project. Up to this point, the investment thesis appears quite compelling, but every investment opportunity comes with execution risks. And this company is no exception. The first risk is geographic concentration, as major revenue is generated from Gujarat, making the company highly dependent on a single state for project execution. While Gujarat continues to remain one of India's fastest growing power infrastructure markets, any slowdown in utility spending, delays in government approvals, could affect the company's order inflows. The second risk relates to working capital. Typically, receivable payments are done in stages rather than upfront, with a substantial portion of the payment is released after material supply, another portion after project execution, and the remaining amount is often retained until final project completion. Third, the company's dependence on government-led infrastructure programs such as the revamped distribution sector scheme. However, slower tendering activity, policy changes, or delays in project approvals could reduce the pace of future order inflows. The next risk comes from execution itself. Across multiple businesses, including transformer manufacturing, battery energy storage systems, and larger EPC projects, each of these initiatives requires capital, technical expertise, and timely execution. Delays in commissioning the new transformer facility, slower ramp-up of manufacturing capacity, or execution challenges in BESS projects could postpone the expected benefits from these investments. Finally, there is the balance sheet. Expansion into transformer manufacturing and battery energy storage systems requires capex, adding debt. While accelerating project range, it also increases financial risk if order inflows slow down. These are some factors that will determine whether the company can successfully convert today's growth ambitions into sustainable long-term value creation. So coming to the overall investment thesis. Now if we step back and look at the entire discussion, a much clearer picture begins to emerge. Viviana Power is building a broader power infrastructure platform, with each business segment supporting the next stage of growth. The foundation of this strategy continues to remain the EPC business, which today contributes nearly 94% of the company's revenue, supported by India's transmission and distribution investment cycle. Building on this foundation, the company has entered transformer manufacturing through ARCH transformers. Although this business contributes only a small percentage of revenue today, it represents a strategic move towards backward integration, targeting a revenue of 500 crore rupees by FY30. The third growth engine comes from battery energy storage systems, creating recurring revenues over 12 years, a platform for building technical credentials. Successful execution in this segment strengthens the company's qualification profile, enabling larger transmission project bidding under the TBCB framework and potentially the HVDC ecosystem. At the same time, Gujarat continues to provide a favorable operating environment. Increasing investments by GETCO, higher spending by state discoms, continued transmission expansion and utility modernization create a healthy pipeline of projects, giving the company an opportunity to steadily expand its order book while improving execution capabilities. However, the real investment thesis does not depend on whether India's transmission sector grows, because that opportunity already appears well established. The bigger question is whether Viviana can successfully convert this industry tailwind into sustained execution, larger project eligibility, and disciplined capital allocation. If management continues climbing from 100 crore rupees projects towards 300 crore rupees and eventually towards national transmission opportunities, the company could gradually transform itself from a regional EPC contractor into a much larger participant within India's power infrastructure ecosystem.
Identify such small cap, micro cap, and SME companies early through our research services, Emerging Titans and Tiny Titans. Emerging Titans is mainly built for mainboard small and mid cap companies, while Tiny Titans focuses purely on SME listed stocks. Across both services, you receive detailed research reports, entry and exit strategy, allocation guidance, and regular updates. So if you want to be part of our research community, you can visit valueeducator.com or check the link in the description. We follow our sprint strategy framework to discover such niche stocks with strong potential. That's it for today's video. If you found this detailed breakdown useful, then like the video, subscribe to the channel, and comment below sprint if you like the detailed research. We will meet again next Saturday with another video at 11 AM.